We deal in communities that don't want to talk about energy transition at all. And then on the mining side of our life, we deal in communities that will not talk about hydrocarbons as an ongoing source of energy in the world. And both of those are unrealistic. We talk about energy as kaleidoscopic, and you will have certain jurisdictions like the East Coast, the West Coast of the US, the OECD, certainly Europe, that will skew more renewable in terms of power and more EV in terms of vehicles. And then you will have groups that do not. And I think the problem is that in sitting in the OECD and reading all of the kind of typical, like, New York Times, Wall Street Journal, FT, Economist, maybe Bloomberg, Axios, you sort of think like, oh, the energy transition is happening and conventional vehicles and conventional fuels are going out of business. The problem is that if we look at the last 22 years, the OECD, which is about 400 million people, has taken demand for hydrocarbons down 2 million barrels a day. And the non-OECD has taken hydrocarbon demand up 25 million barrels a day. So it's just a law of large numbers. And the fact is that if you wanted to say no traditional energy, that's unrealistic. We don't have enough copper in the world to supply that. But if you wanted to say no renewables, we don't have enough oil or LNG to supply the world. So it has to be kaleidoscopic. And it's really an all of the above energy solution, including nuclear, which last year came into the conversation as carbon-free.
Kaleidoscopic. I'm totally stealing this one. Yeah. So Kate, when we have this interest, though, in the energy space among energy companies, does that make exit strategies more appealing for you? Like, are you buying more or are you selling more right now? Because for a while it felt like assets in private equity when it related to energy was stuck. It was going nowhere fast.
So in 2018, we had a number of oil and gas companies. One could probably argue too many in the US. 60% of the oil and gas companies that existed in 2018 don't exist today because of M&A. So there has been massive consolidation in this space. And we're probably not going back to the 70s where it was like the seven sisters, you know, 7 big companies, but we might be going back to 15 companies. So definitely there is consolidation, and that consolidation was localized in the Permian Basin in West Texas until this year, and I would say now the Permian's pretty consolidated, and now it's going to other basins in the U.S. So this is sort of a cross-basin U.S. consolidation story. That's number one. Number two, it's definitely cheaper to buy assets. So 2014, 15, we would pay 7 to 10 times EBITDA. We're buying assets now for 1 to 3 times EBITDA.
But doesn't that mean that you're does that mean that you're selling assets for that too, though?
It does not mean that, because in a lot of cases people need to pay for inventory. Because the reason, like to your point, why are the mid caps buying small caps, or why are the small caps trying to buy, like why is this game of Pac-Man happening where it's either get consolidated or consolidate? It's because people are short inventory. So in your private portfolio, if you have inventory, or if you're a public company and you have inventory, you are attractive, and it's a game to get bigger before all of the chips are sort of held by big public companies.
You mentioned nuclear. What is a reasonable nuclear policy from your perspective? Because I'm hearing more about the technology changing now. We don't have to build these monster reactors. We can build little ones. And that seems reasonable to me.
So I actually think there's a really interesting fight that's sort of like brewing between big tech and LNG exporters, frankly, because big tech knows that they are massive power consumers and they need power quickly, especially if you're sort of positing that it's like this AI fight nationally that's in national interest. So if you talk to big tech, they'll say, you know, AI ushers in a nuclear renaissance, and it's not that hard because we have these small modular nuclear reactors. This is an existing technology. It's on submarines all over the world. The fact is, you'll probably see some of that, but you'll also probably see some of it go to natural gas and some more go to renewables. I think that big tech is probably going to have to embrace like a kaleidoscopic power outlook.
We haven't put any nuclear plants in operation forever, right?
Right, yeah.
So to say I'm going to power this data center with a small nuclear plant, that is a huge deal.
Yeah. There's also probably not the uranium to power a nuclear renaissance right now, particularly with the House and Senate now restricting 20% of the uranium market to be imported into the U.S. And that matters because the U.S. is the largest consumer of uranium, and we are now, like as of 2027 or 2028, not allowed to buy uranium from Kazakhstan or Russia.
So yeah, but to your point, Paul, they are considering restarting a nuclear plant that was closed. That's quite big. And the SMRs, these small modular reactors, they're just, the economics are so wide. Like you just can't make the economics work yet.
Okay.
But I like that you brought up the uranium factor, because what we are seeing is oil companies go into mining, particularly with lithium. And I'm wondering if there's a way that you are thinking about your oil and your real play, like the hard asset plays? Like, are there plays for you there?
Yeah, I think, well, definitely. So oil and gas companies are actively looking at lithium because we extract lithium when we bring water out of the ground in saltwater brine across the U.S. So that is definitely a play. The other thing is that a lot of the mining companies don't know how to lease acreage to do mined expansion, and that's something that oil and gas companies are very good at. So I actually think you're seeing this like merger of the natural resources brethren in a lot of ways. And the similarities are fascinating because like mining and oil and gas globally have both decreased capex 40% since the 2013-2014 timeframe, and mining and oil and gas companies also are only spending 40% of cash flow on capex today, and they're both essential for the energy transition. So I think you're probably going to start to see a lot more intersection of conversation around oil and gas and mining companies, just as these natural resources businesses that haven't really been super relevant for the past 10 years but are increasingly very relevant.